Okay, let's unpack this. Today, we're diving into the monthly crypto trading review of Mr. Finance at Dawn. He is a trader who recently shared how he navigates, well, the wild world of digital assets.
Yeah.
Our mission isn't just to, look at a reported profit figure, but to genuinely extract the actionable insights, the strategies, the mindset behind his trades.
Right.
Think of it as peeling back the layers to understand the how, not just the what, for you listening.
What's truly fascinating here, I think, is getting such a transparent look at a trader's actual process. It moves beyond just the headline dollar amount and really zeroes in on the methodology and, honestly, the sheer discipline applied. It's a notoriously volatile market. We all know that.
Definitely.
So our goal is to kind of uncover the wisdom in his approach, not just for copying trades, obviously, but for understanding how you might achieve consistent gains without constantly chasing, fleeting hype.
Absolutely. And we've dug deep into Adnan's monthly crypto trading deep dive and his playbook excerpts. So we're going to distill the essential nuggets on, well, everything. His core strategy, risk management, which is huge, and the psychological side too. That resilience that holds it all together.
Yep, the whole package.
So to set the scene, what was the market actually like for Adnan this month? From the sources, it sounds like a real roller coaster.
Oh, it was.
We're talking an environment packed with volatility, driven by macroeconomic shifts. Those can turn on a dime. Bitcoin flirting with key resistance levels always makes people nervous. And of course, meme coins doing their usual dance. Unpredictable stuff.
Right. The usual chaos.
So how does one even begin to operate in that?
It's a great question, and it immediately highlights Adnan's core principle. When you're faced with such unpredictable conditions, how you maintain focus.
Right.
His stated goal wasn't, and this is key, to chase pumps. That urge to jump into anything rocketing up, he avoided that. Instead, his focus was to execute disciplined trades with tight risk management. And he was super selective, concentrating only on 3 specific pairs: DOGE USDT, BTC USDT, and Sol USDT.
Only 3.
Only 3. Tells us he's not spreading himself thin. That's a classic rookie mistake. He's choosing his battles very, very carefully.
Okay, that makes sense. Now, here's where it gets, I think, particularly interesting. Adnan talks a lot about using a multi-time frame approach.
Yeah.
For anyone listening, maybe you are trying to refine your trading entries. This sounds like it could be powerful, but maybe complex. How does a trader actually implement that effectively? Especially under pressure, what does it really mean?
Well, it's essentially about getting like a panoramic view before you zoom in on the specifics. It's perspective.
Okay.
So Adnan starts by looking at the daily and the 4-hour charts. These longer time frames are kind of his binoculars, right? They help him identify the broader trend bias.
Yeah.
Is the market generally heading up, down, sideways?
Got it. The big picture first.
Exactly.
Yeah.
Once he has that larger context, that macro understanding, then he zooms into the 15-minute and the 5-minute charts.
Okay.
These shorter time frames are like his magnifying glass.
Right.
He uses them to pinpoint the precise entry points for his trades.
So it's not just picking a random point, but making sure your immediate decision fits the bigger trend.
Precisely. And if we connect this to the bigger picture for you, a multi-time frame analysis is just crucial for building conviction in a trade.
Conviction. Okay.
Yeah. It helps confirm that the trend you're seeing on, say, a 5-minute chart isn't just some random blip, right? But it's actually supported by the larger movements on the daily chart. This layered approach, it dramatically reduces the noise from those shorter time frames. Gives you a much clearer picture of where the market might actually be headed.
Like seeing the forest before the trees.
Exactly. It ensures your micro decisions align with the macro trend. Traders who ignore this, they often find themselves fighting the main current, even if their short-term signal looked good for a moment.
Okay, that layered understanding really provides the foundation. So now we get the framework. Let's peel back the curtain. How did Adnan actually apply this in the heat of battle? Let's dive into some specific trades, starting with BTC USDT.
Right. So he recounted catching a pretty significant breakout above a key level, and this came after a, quote, textbook bullish flag.
Okay, textbook.
Yeah. He described the entry as clean, the stop loss is tight, very important, and he scaled out in 3 stages. It sounds like, well, really solid execution.
Bullish flag. That's a classic pattern, I know, but for those listening who might be less familiar, what does that actually look like, and why is it considered textbook?
Sure. So a bullish flag, imagine a flagpole.
Right.
That's a sharp, strong, upward price move, a big surge. After that initial run-up, the price usually consolidates. It kind of drifts sideways or slightly down, forming this small rectangular channel shape that looks like a flag hanging off the pole.
Oh, I see it.
That flag pattern, it signals that the buyers who pushed the price up initially are basically just taking a breather. They're still likely in control.
Okay.
And the expectation is that once that consolidation, that flag part ends, the price will break out upwards again, continuing the original trend. It's textbook because it's, well, frequently observed and often quite reliable when it confirms. Adnan recognized it and was essentially betting on that next leg up.
Got it. And the scaling out in 3 stages part, what's the advantage there? Why not just take all the profit at once?
Good question. Scaling out means he didn't exit his entire position at one single price point.
Right.
Instead, he took profits off the table in chunks as the price moved in his favor. So maybe he sells a third of his position at his first profit target,
Okay.
then another third at a second higher target, and maybe lets the final third run with a trailing stop loss to catch any further upside.
Okay.
It's a really smart way to lock in gains, reduce your risk as the trade progresses,
Makes sense.
making sure you bank some profit, even if the market suddenly reverses, but also lets you participate if the move keeps going further than you initially thought. It balances greed and fear, essentially. Avoids holding too long or getting out too early.
Very strategic. Okay, moving on to DOGE USDT. Adnan described this one as trickier.
Mhm.
He spotted a fake out on the 1-hour chart, and he waited for confirmation, and then he shorted the retrace. Said it wasn't a moonshot, but, added solid gains. That fake out part sounds like a trap.
It often is. A fake out is basically a deceptive price move. It looks like it's breaking a key level, say, pushing above resistance, but then boom, it quickly reverses and goes the other way.
Ouch. Catches people out.
Exactly. Catches impatient traders off guard. But what's fascinating here is Adnan's discipline. He saw the potential fake out, but he waited for confirmation.
Didn't just jump in.
No. He didn't just react to that initial spike. He likely used his broader daily and 4-hour context to suspect it might be a trap. Then he patiently waited for the shorter time frame chart, the 1 hour, to confirm the reversal before he entered.
Okay.
So when he shorted the retrace, it means he entered a bearish position betting the price would fall after that fake upward move failed, and the price pulled back slightly towards that resistance level it tried to break.
So, betting against it after the failed attempt?
Precisely. It wasn't about catching the absolute top, but about identifying a high probability reversal after the market showed its hand. It really underscores that reacting instantly isn't always best. Sometimes, waiting for that retrace gives you a safer, more confirmed entry.
So patience was really the key for that DOGE trade.
Absolutely critical. Not getting fooled by the initial noise, waiting for his specific setup, especially when the bigger picture analysis maybe hinted it was a trap.
Right. Okay, finally, USDT. This was described as a momentum play. Adnan used volume divergence and RSI confluence to time the entry. Sounds technical. The move was fast, and he exited before the weekend chop. Okay, lots to unpack there. Volume divergence, RSI confluence, weekend chop.
Yeah, let's break those down. Volume divergence. This happens when the price of an asset is moving one way, let's say making new highs,
Okay.
but the trading volume, the actual amount being traded, is moving the other way. It's decreasing.
Interesting.
It often signals that the underlying trend is weakening. Fewer participants are supporting that price move. It's like the buying pressure is drying up. It could be a warning sign that a reversal might be coming.
Got it. Less fuel for the fire.
Good way to put it. Then RSI confluence. RSI stands for Relative Strength Index. It's a momentum indicator measuring the speed and change of price moves. Ranges from 0 to 100.
Right, overbought, oversold.
Exactly. Above 70 is often considered overbought, below 30 oversold. When Anand talks about RSI confluence, he means the RSI was likely showing something, maybe divergence itself, or hitting an extreme level that agreed with or converged with what the volume divergence was suggesting.
So multiple signals pointing the same way.
Precisely. Like different instruments in an orchestra hitting the same note, like you said earlier, that confluence builds strong conviction for a trade. It wasn't just one indicator, it was multiple things lining up.
Okay. And weekend chop, what's that about?
Weekend chop.
Yeah.
That refers to the often erratic, sort of unpredictable price movements you see in crypto markets over weekends.
Why does that happen?
Well, typically liquidity is lower, fewer big institutional players are active, trading desks might be closed, spreads between buy and sell prices can widen.
Okay.
This can lead to more volatile, sometimes directionless, choppy price action. It increases risk without necessarily offering a clear reward or trend to follow. So, Adnan's decision to exit before that chop hit, that's pure risk management.
Smart. Get out while the getting's good.
Exactly. Take the profits from the momentum play and step aside before things get messy and unpredictable. Avoid unnecessary risk you don't need to take.
Now this next part. Adnan says this is the part most traders ignore. Big claim. Risk management.
The unsexy part.
Right. But he emphasizes it's supremely important. So, what was his golden rule and why should you listening pay such close attention? He was absolutely strict. Never risk more than 1.5% per trade. That feels incredibly disciplined.
It does, and it raises that important question. Why is such a seemingly small percentage so critical?
Yeah.
It's all about capital preservation. Above everything else, think about it. If you have a $10,000 trading account, risking 1.5% means you're putting only $150 on the line for any single trade idea.
Okay.
If that trade goes wrong, hits your stop loss, you lose $150. It stings, sure, but it's not catastrophic. It doesn't cripple your account.
Right. You can keep going.
Exactly. This rule ensures that one bad trade, or even a string of bad trades which will happen, doesn't wipe you out. If we connect this to the bigger picture, disciplined risk management is truly the bedrock of long-term trading success.
Bedrock. I like that.
It enables you to survive market swings, absorb losses, and stay in the game long enough to actually learn and capitalize on future opportunities. It's honestly the difference between having a trading career and just being a short-term gambler. And yes, studies show it time and again. Over-leveraging, poor risk management. Biggest reasons traders fail.
Staying in the game long enough to learn. That's powerful. He also shared something else interesting. He journaled every setup, including the emotional state he was in.
The journal, yes.
And deliberately avoided revenge trading, stuck to his plan, respected his stop losses. He even credited this discipline with saving him from 2 potential drawdowns. Really highlights the human side, doesn't it?
Oh, absolutely. Journaling emotions, that's key.
Yeah.
Key to understanding the psychological biases that trip up so many traders.
Like fear and greed.
Fear, greed, impatience, frustration, all of it. We all have that internal chatter, those moments where emotion wants to take over. By writing down his emotional state during the trade process, Adnan gained crucial self-awareness.
Seeing his own patterns.
Exactly. Identifying patterns in his own decision-making that might have been driven by emotion rather than logic, and avoiding revenge trading, that impulsive urge to jump right back in and win back money after a loss. That takes serious discipline.
I can imagine it must be tempting.
Extremely. And consistently respecting stop losses, those preset exit points. Non-negotiable for systematic rules-based trading. You set the rule before the trade when you're calm and rational. You have to follow it when things get heated.
No exception.
No exceptions. Because who hasn't felt that itch to just get back at the market after a loss? But that's where structure, his process, helps you beat emotion. Emotion can be your biggest enemy for consistent profits. It's a mental game as much as a strategic one. Adnan clearly works hard on both.
Mental and strategic. Okay, so pulling it all together, what were the big lessons Adnan distilled from this month? He outlined 3 top takeaways. Really valuable principles, I think, for anyone listening. First, patience pays. He said the best trades came from waiting, not reacting.
Yeah, and this is just universally applicable, isn't it? Not just trading. Patience stops you making impulsive, probably low probability decisions. It lets those really good setups, the ones that meet your strict criteria, actually emerge instead of just chasing every little flicker on the screen. And, you know, it's interesting. A common trap for new traders is overtrading.
Yeah.
Making too many bets.
Right, feeling like you always have to be doing something.
Exactly.
Yeah.
But statistically, overtrading often correlates with lower profits.
Yeah.
The really good traders, they often execute fewer trades, but higher quality ones, because they have the patience to wait for their specific edge to show up.
Makes sense. Okay, his second takeaway. Volume is king. He said he ignored hype and focused on volume structure.
Oh, this is powerful, especially in crypto with all the social media noise. Anyone can pump a narrative online, right? But consistent, high trading volume behind a price move. That's like the market itself voting with actual money.
Objective data.
Exactly. It gives you objective insight into real market conviction. It cuts through the surface level hype or that temporary social media buzz. If a price is shooting up but the volume is low or falling, that's often a red flag. Could be a weak move, likely to reverse. Adnan focusing on volume means he was looking for genuine institutional interest or broad participation, not just, fleeting speculation.
Looking for the substance behind the move. Got it.
And his third point, news matters, but only in context. He noted that CPI data and Fed commentary move markets, sure, but crucially, he used them as volatility windows, not trade triggers.
This is such a nuanced but vital distinction for critical thinking, for you navigating these markets. Major economic news, CPI, Fed announcements, they undeniably inject massive volatility. Prices can whip back and forth like crazy.
For sure.
But Adnan didn't jump into a trade just because the news came out. He didn't trade the headline itself.
Instead, he saw these events as volatility windows. Periods where maybe his pre-planned technical setups might play out more dramatically, or maybe where he could capitalize on the market overreacting after the initial news shock wore off.
So the news created opportunity but didn't dictate the entry.
Precisely. He understood news as a catalyst for movement, but his actual trade entry was still dictated by his structured plan, his technical analysis, his process. Not the immediate headline flash. It's about recognizing opportunity within your framework, not letting external events hijack your strategy.
Very disciplined approach to news. Okay, so beyond the strategy and the mindset, Adnan also shared some practical tools he uses. For efficiency, right?
Yeah, the toolkit.
He listed TradingView for charting, pretty standard, I think.
Yep, industry standard.
CapCut for content creation, which is interesting. And a custom Google Sheet to track trades and performance. And here's a little modern twist. He experimented with AI tools to generate market summaries and thumbnail ideas for his YouTube channel.
You know, what's fascinating there is the holistic approach, right? It's not just about placing the trade. It's about managing the entire process. Analysis, execution, tracking, review, even sharing insights, apparently, with CapCut for content. Trading is a business, and he treats it like one using the best tools for each job.
Right.
TradingView, essential for charting. That custom Google Sheet for tracking, that's absolutely non-negotiable if you're serious. It lets you review performance objectively, see what works, what doesn't, spot those behavioral patterns we talk about.
Data-driven improvement.
Exactly. And using CapCut suggests he understands that maybe sharing his process reinforces his own learning, the AI experimentation. That just shows how modern traders are integrating tech, always looking for an edge. Even in workflow automation, it proves organization and leveraging tools are just as critical as the trading strategy itself.
The whole ecosystem matters. Okay, so Adnan got a great question from his community. How do you stay consistent when the market is unpredictable? That's the million-dollar question, isn't it?
It really is.
What was his powerful answer for you listening?
His answer, I think, really gets to the core of his trading philosophy. It's almost a mantra, he said. I don't try to predict, I react.
React, not predict.
I follow structure, not emotion. And I always remind myself, the goal is to survive first, thrive second.
Survive first, thrive second. Wow.
Yeah, it just emphasizes this adaptive, rules-based approach over trying to guess the future, over speculative forecasting. It's about embracing the market's inherent unpredictability, not fighting it. By prioritizing survival capital preservation and following his structure, his process, he sets himself up for sustained success. It's a profound shift, isn't it? From trying to be a prophet to being a disciplined reactor, an executor.
It really is. Okay, so wrapping this up, what does this all mean? This deep dive into Adnan's month, it reveals so much more than just a profit number, right? It feels like a masterclass in applying structure, discipline, adaptability to a world, the crypto market, that's inherently volatile. His own words really sum it perfectly. It wasn't luck, it was structure, discipline, and adaptability.
Couldn't say it better.
And his final thought, the takeaway for all of us, for you, was your edge is in your process.
Yeah. And if we connect that to the bigger picture, what truly stands out is that success in volatile markets, or really in any complex challenge you might face, isn't about having a crystal ball. It's not about predicting the future.
Right.
It's about having a robust, adaptable process, a system. It's about systematically managing risk, understanding your own emotions, your psychology, and relying on objective data like that volume analysis over fleeting hype.
The process is the edge.
Exactly. And maybe the provocative thought for you to consider is this: how much of your own success in whatever field or endeavor you pursue is really down to luck versus having a deliberate, disciplined, adaptable process? Where does your own edge truly lie?
That's a really powerful question to reflect on, a great place to end. Thank you for joining us on this deep dive today. Your curiosity, as always, makes these explorations so worthwhile.
Always a pleasure.
Until next time, stay curious and keep learning.
you.